Welcome to the Money and Meaning Show with Jeff Bernier, a show dedicated to helping you gain the confidence and freedom to lead a life of personal significance and help you get your actions and resources in alignment with what matters most.
Well, hello and welcome to the Money and Meaning Show. My name is Jeff Bernier. I am your guide and host today, and so happy that you decided to spend a few minutes with us. I am really excited about our show today. I've got a special guest, Kacie Walsh from Dimensional Fund Advisors. Kacie's a vice president at Dimensional, and in a recent meeting, she was making a presentation about some of the things in the Dimensional toolkit in terms of helping us keep more of what we make on our investments. And so we're going to talk a little bit about that today, but let me start. Kacie, welcome to the show. Really excited to have you here.
Yeah, thank you, Jeff. Excited to be here.
Yeah, really appreciate it. I always like to start the shows just getting a little bit of information about you. So we'll get a little personal here. Can you tell us just a little bit about yourself and how you found yourself as a vice president at Dimensional Fund Advisors?
Yeah, so let's see. Maybe we go back farther to the beginning. I grew up in the suburbs of Chicago, and I made my way down to Austin for undergrad. I went to University of Texas at Austin. I was thinking about this morning on my drive to the office. That might not be great news for some of the viewers on your show. We've got a lot of SEC folks maybe who listen in on the podcast. And I joined Dimensional in 2018. So I started my career in consulting and then joined Dimensional a bit after that. When I started at Dimensional, I was entry level. I was an associate, and I was working primarily with enterprise type RA firms. For years, I was a regional director, and I overlooked a region, right, of financial advisors, such as yourself, Jeff. Helping financial advisors on investments, messaging, business strategy. Helping advisors provide great experiences to their clients. And I had this passion project for years on the side, which is, I think, what we're going to talk a lot more about today, where I was on what we used to call a committee about 5 years ago that contributed to some of these different tax-focused solutions at Dimensional. Gotcha. Originally, it was for things called separately managed accounts. Right. So I was on this committee on the side for years and was contributing on some of the client engagement for these different investment solutions. And then about a year ago, I went full-time on our tax investment solutions. And so now I spend all day, every day talking to advisors, talking to clients about the use cases and the education around different specialized tax solutions.
Got you. So your primary role now is to be sort of the educator, teacher, communicator between Dimensional and the advisory community on how these programs work and where they're appropriate and those kinds of things. Okay.
Exactly. Yeah. And it's a space of our industry that's evolving rapidly, right? Yeah. There's a lot of components to consider. And so, I think about this stuff all day, every day. I come in and help some of our regional directors have these conversations with advisors such as yourself. And then, I spend a lot of my time also talking to clients of our advisory clients and helping them understand the use cases of these different solutions. Yeah.
Well, we'll talk about in a moment about how Dimensional may be unique in some of these areas. But I think that Dimensional is so well suited to add value here because you're so data-driven. The evidence has to be there. So if you're going to do something different, there's got to be an academic and evidence that it works and it can create value. You're not usually going into fads, I guess is what I'm saying, for marketing purposes. I mean, it's got to be real value. So, when you and I first met, it was in Miami a little over a year ago at the Future Proof Conference, and I was just really doing my preliminary due diligence on your separately managed account, what we're calling an SMA here for you guys that may not be familiar with the term. And, I had a lot of questions, but at the end of the day, for me, the motivation was, again, it's not about gross returns. It's about net of fee, net of inflation, and net of taxes. And obviously taxes are a big drag. And obviously Dimensional has now become a big player in the exchange-traded fund world. And I want to talk to you a little bit about just the product lineup, how the product lineup has grown in both the ETF world and the fund world, because I constantly was frustrated when we did tax loss harvesting as an example. So for those of you that aren't familiar with that term, we would look at portfolios, and if there was an opportunity to harvest the loss that could be used to offset either a gain or to be used against future gains, we proactively do that throughout the year. But at the same time, we don't want to be out of the market. So we want to get the money back to work in the market. But the problem was oftentimes the replacement securities that I had, if the market ran up right after I bought the replacement security in order to take the loss for tax purposes, I couldn't get out of the new security. And so you really needed a security that you felt comfortable with that had the same philosophy. So, we don't have to go into a lot of detail about this, but tell me a little bit about the lineup and why that's been good for me and good for other investors in terms of having more choices in the fund and the ETF lineup. Any thoughts on that?
Yeah, well, so I think you're making a great point even before we talk about the fund lineup, which is the purpose of the podcast today is talking about tax management and certain investment solutions that have components of those solutions related to tax management. Right. But what you're talking about is even broader, which is no matter the investment solution you're in, you might want to engage in what's called tax loss harvesting of that investment solution to also consider capturing losses when they're available, but maintaining investment exposure so that you can enjoy capital appreciation, right? And you can get return for the risk you take by being invested in the stock market or the bond market. So what you're referring to with tax loss harvesting, when you think about Dimensional historically, we primarily had mutual funds. And over the last 5 years or so, we've invested heavily into the ETF part of our business, so exchange-traded funds. Today, we've got over $200 billion in ETFs, right? And we've got much more than that in mutual funds. But when you think about tax loss harvesting, you want to ensure that if you're in a certain asset class and it's down and you sell that fund to capture a loss to reduce a tax bill, that you're going to go to an alternate that has similar characteristics of that original asset class. Because what's the goal here at the end of the day is still investment returns. And so I think what you're alluding to is this idea that we've got a mutual fund and ETF lineup at Dimensional now that essentially mirrors itself. And it gives you the ability as the advisor for your client to maintain that investment exposure and maybe move between vehicles. And then within our ETF and our mutual fund lineups, we've got a lot of different versions of funds within the similar asset class to give you even further options for tax loss harvesting alternates. We want to be able to support your endeavor of capturing losses for your clients in the way that you manage their investment allocation. And then in addition, the level deeper that we'll get into, how do we think about taxes within the actual investment solutions themselves?
Right. Well, and from the advisor standpoint as well, if we have a philosophy that we want to capture these various premiums, we've already determined that we don't want to be in a normal market cap weighted index. We want to try to do a little bit better. So the replacement security that I use, I don't want it to be just another market cap weighted index, if possible. I want it to be something that expresses that idea. So again, really been helpful to have this larger set of options. So you presented in the last meeting I went to that you taught at a great chart that was like a toolbox, and it was sort of a continuum from really wide appeal and wide usage and starting at mutual funds, and then it just continuously went to the right with other vehicles. And when I look at that, you start with mutual funds, and mutual funds have traditionally been thought of as being relatively tax inefficient. And so tell us a little bit about how Dimensional has made improvements in the funds and what you do in the funds to make them even more tax efficient than the typical mutual fund.
Yeah. When I think about tax efficiency, to me, there's three pieces of tax efficiency, and most investors actually only think about one or two of those three pieces. There's income from being invested in mutual funds when companies within the mutual funds have a dividend, right? That income gets distributed through. There's short-term capital gains, and there's also long-term capital gains. And where mutual funds, I think, historically have had this reputation of being less tax efficient is one, because they distribute capital gains at the end of the year down to investors to pay taxes on, versus ETFs essentially allow you to decide when you want to sell the position And therefore, when you want to realize gains, the gains just sit in the vehicle. And then also there's the income component. So if we kind of break those down into some further details, income first and foremost is a really important part of tax efficiency. And it's something that we consider across all of our vehicles at Dimensional: mutual funds, ETFs, SMAs. When you've got companies in these mutual funds that distribute dividends, there's two different types of income that you can get. There's qualified dividend income, which is taxed at a lower tax rate. And then there's non-qualified dividend income, which is taxed at a higher tax rate. And when you look historically at Dimensional's mutual funds, we do a really good job of trying to maximize qualified dividend income in our funds. And so that gives us an advantage relative to other mutual funds that are out there that might be distributing non-qualified income out to you. Therefore, you're paying higher tax rates on them. Therefore, you have less dollars at the end of the day in that after-tax return. So that's one piece. Then the gain piece, as I mentioned, is what I think a lot of investors think of when they think of tax efficiency. For us at Dimensional, as you know, Jeff, because we work primarily with financial professionals, one thing I think that works well for us is we tend to have a little bit more stability in our cash flows, essentially, that come in and out of our portfolios, because your clients work with you and you help them stay in their seat and you help them create a plan, and you help them be disciplined investors when investing gets really tricky, in times like the pandemic or in April of this year. And so how does that actually impact tax efficiency, working with financial advisors? Well, because when you have moments of market volatility, what we find at Dimensional is we maybe have less redemption requests out of our funds in those moments because advisors are doing a really great job. And what that prevents us from having to do is sell securities in a mutual fund, and therefore sell securities that have gains associated with them, and then distribute those gains down to the actual investors. So that function, the way we manage cash flows and turnover in the funds, that alone helps us with the capital gains. And then I think where we're probably going to go next and get a little bit more into is the mechanics of how gains are managed within a portfolio, and then also how they're distributed.
Yeah, I mean, I've always thought, that the mutual fund, the disadvantage of the fund was I have a tax outcome based on what other investors are doing. Because if they're taking redemptions, it's affecting me, even though I didn't get a redemption, but I get the capital gain. Where the ETF obviously, eliminates that to some degree. You put a favorable spin for guys like me, the advisors, because obviously the less panic selling during difficult times, the less the distributions are going to be. So having an advisor could be helpful there. So anything else on the tax efficiency of ETFs versus funds?
One thing to talk about that will maybe transition us into the ETF piece is what is it that ETFs do that's different than mutual funds? And I'm not talking like now dimensional versus non-dimensional,
ETFs
but just
general.
as a vehicle. Yep. Yeah. What is it that they do that helps with tax efficiency? Well, what they essentially do that's different than a mutual fund is that when you have cash flows coming in and out, so people buying or selling into the ETFs, ETFs are able to work with this, let's just call it a third party, another organization, another entity that's a part of this transaction, and create and redeem shares with this other organization, which allows the ETFs to be a little bit more tactful around avoiding realizing gains within the ETF itself, because you have this kind of in-kind mechanism that you can use. Mutual funds historically have not been able to use that type of a mechanism. And so therefore, when you've got somebody who wants to transact, so an investor that wants to sell their mutual fund positions, the mutual fund is just forced to sell stocks within the fund, versus the ETF is working with this other organization to think about create and redeem. That is what is the main, I would say, differentiator between the ETF and mutual fund vehicle itself. But at Dimensional, we've actually started using that mechanism in our mutual funds. So when you look at Dimensional's mutual fund lineup, and you look at, let's say, our distribution estimates for this year, I think it's only about 5 of our mutual funds, something like that, of our kind of key mutual fund lineup are expected to have a distribution. They're long-term distributions only, and it's 0.07%
very low.
distribution.
Yep.
So very low, and it's only on the long-term side. Compare that to the industry. A lot of mutual funds are still distributing out gains at the end of the year because of all the reasons that we've talked about. They maybe don't have the similar level of stability of cash flows. They might be forced to have some more turnover, and they're maybe not using that ETF mechanic of an in-kind redemption in that mutual fund vehicle. Our objective at Dimensional has been, let's try to neutralize the tax efficiency between mutual funds and ETFs. Back to the point you made at the start, if you're using those interchangeably in an asset allocation to pursue factors and outperformance, can we make it where you're not forced to make a decision on a vehicle based on the tax efficiency of the vehicle or the fee associated with the vehicle, but more what vehicle just makes sense for your clients and for your business?
Yeah, I remember seeing your co-CEO, Gerard O'Reilly, speak about a year and a half ago when you were really ramping this up big time, and he was obviously very excited about it. And he said the very statement about being agnostic on whether, from a tax standpoint, on whether you use the fund or the ETF. And that seemed hard to believe to me because of the in-kind redemption process. But of course, your 2024 year-end results were fantastic in terms of tax efficiency in the mutual fund. So you guys walked the walk, didn't just talk the talk on that. So very exciting. So the long answer here is generally the typical mutual fund doesn't do this. So you end up getting a lot of realized gains. But managers like Dimensional that are doing this in-kind process in the funds has made it much more tax efficient and more similar to ETFs in that regard. So that's pretty cool.
Yeah. If you look at the tax efficiency of Dimensional's mutual funds and ETFs, right, these like sister strategies we've talked about, they're really pretty similar numbers, right? Yeah. You're talking usually about tax efficiency ratios in the maybe mid to high 90s. And if you look at the ETF and mutual fund equivalent side by side, they share pretty similar tax efficiency outcomes.
Well, a couple of years ago, you guys were working on trying to get the ability to take your mutual funds and create an ETF share class, which would be very helpful to my typical client who's got a mutual fund that has large unrealized gains that we don't want to sell, obviously, because we don't want to realize the gain unless they need the cash or we're making a portfolio allocation change. But all things being equal, we don't want to sell it. But traditionally, we've thought at it as being less tax efficient. So you guys have been working on getting the ability to give our clients the option to exchange that mutual fund to an ETF share class. And I know you just got some recent news on that from the SEC. Y'all been working on this on behalf of your investors, I guess. I mean, it seems like this is something you're doing for the end investor. And can you give us the update on that?
Yeah, it's certainly something we're doing for the end investor. In addition to the advisors, Jeff, like you, as you're trying to think through how do I create, great investment allocations for clients. So let me back up a little bit. You're talking about the idea of share classes between mutual funds and ETFs, and in order for us to offer share classes of these funds, we needed what was called exemptive relief from the SEC. And so this is something that we've been working on for years at Dimensional. About a year and a half ago is when we kind of revisited this topic much more, I would say, loudly out in the industry. And what the result of that was we became first in line of dozens and dozens of asset managers asking the SEC to give us this exemptive relief where we could make share classes of our mutual funds and our ETFs. There were numerous edits that had been made to our application. And what was really exciting was that the Dimensional application kind of became the template and the standard for a lot of these other organizations. That filed for share class structure with their fund lineup. What we're dealing with now is a pretty clear expectation from the SEC that we have approval for share class structure, and we've actually filed to launch some ETFs now as share classes of our mutual funds. Now, right, there's a process that you have to go through when you file to launch these different funds, and we can leave that conversation for another day. But the really exciting outcome for investors, what that means is, we could have this structure now where mutual funds and ETFs are share classes of one another. And what that does is it just further improves the tax efficiency of these vehicles for clients, further improves those after-tax outcomes for clients by being invested in these vehicles. And then potentially one day maybe allows folks that are in, let's say, the mutual fund side of a share class to have I describe it as kind of a one-way ticket that's tax-free to the other vehicle without having to realize any of those embedded gains underneath.
Yeah, so if you're in a mutual fund and you want to be an ETF, ultimately you should be able to do that.
Yeah, that's the thought behind it. There's a lot of operational complexity to making that happen, right? We're in the early days of this, but the first piece that's exciting is just the improvement in tax efficiency, even from where we're at today. And then that second piece is moving from mutual funds to ETFs in a tax-neutral manner.
Yeah, one of the things I've come to appreciate about the ETFs, now maybe the mutual funds work the same way now because of the in-kind exchange opportunity, but it does give you guys the ability to upgrade the portfolio without tax cost. So if we're trying to, if we're trying to target, a factor, more profitable companies and less profitable companies, or, prices obviously change all the time. And so if there's securities that you want to upgrade, now you can upgrade them in a more tax efficient way, especially in the ETF through the in-kind exchange, but maybe now even on the mutual fund. Okay, I want to move on to what we were talking about in Miami for a few minutes, and that's separately managed accounts. And back in my previous life, before I was as wise as I am today, I was not using evidence-based investing. It was a little bit more of an active strategy in our portfolios, traditional active strategies in our portfolios. And we were big users of separately managed accounts for the illusion that we were going to get customization. And I say illusion because it turned out they weren't quite as customized as we had hoped they would be, and the tax benefits of separately managed accounts. So can you just sort of explain to the listener, I mean, what you're doing is certainly different than that, by the way, but can you explain to our listener sort of what a separately managed account is, who might consider it, and what sort of the use cases are for an SMA?
Yes. When you consider mutual funds and ETFs, which is what we've been chatting about for the last 20 minutes or so, the way to think about it as an investor is you are buying shares of a box, right? There's a box, and in that box, there's a bunch of securities, there's a bunch of companies, thousands maybe. And as an investor, when you buy ETFs or mutual funds, you're buying shares of that pre-built box. Now, an SMA, a separately managed account, what that vehicle does is instead of buying shares of a box that has a bunch of companies in it, we're buying all the companies direct now. So let's go through an example. Let's say you've got the S&P 500, right? Most investors are familiar with that index. You can buy an S&P 500 fund, right, and buy shares of the fund. An SMA, a separately managed account that's for an S&P 500 allocation, would buy the stocks in the S&P 500 directly at a high level. So why does that matter? Like, what are the pros and cons of that approach? Buying shares of a box versus buying stocks direct. When you buy the securities direct, to the point you made, Jeff, you can customize, right? We can make the decision that we want to exclude certain types of companies based on our values. Maybe we want to incorporate our employment considerations. Maybe we've got a list of securities we're not allowed to trade because of what we do for our professional lives. Or maybe we just have an aversion to one company for one specific reason, and we want to have a great investment experience, but we want to remove that company. So they give you the ability to have a personalized investment experience. Where we find most people wanting to use SMAs is much more in the camp of they want elevated tax management. When you think about owning all these individual securities directly, what it's doing is it's giving you a lot more opportunity to do tax loss harvesting, which we talked about at the beginning, right? When a company is down, its price is down, maybe we sell it and capture a loss, which we can use to offset a gain somewhere else, and then we go to a substitute for that company. So we still try to maintain having a great investment experience, right, and creating appreciation on our assets over time, but we also get capital losses along the way, which help us lower tax bills. It can help us lower tax bills in a couple ways, which I'll touch on and then I can pause. One, a lot of folks will use SMAs to unwind positions that have a lot of embedded gains in them. And they'll use the losses that you might create in your SMA through that tax loss harvesting engine to unwind other positions tax neutrally.
Gotcha.
The other way we see folks using SMAs is not to necessarily unwind other investments, whether it's a single stock or an ETF, but they say, I'm selling my business in a few years, and I'm going to have to realize a bunch of gains when I sell my business, or I'm selling a property, or, I'm selling some of my mutual funds in a few years. When you go do that, you're going to have a tax bill in most cases. And so you could also use an SMA to bank these losses and carry them forward to whenever you have this tax bill that actually happens. The whole name of the game with especially a dimensional SMA is we still want to provide you with a great investment experience, right? The investment's still at the core. We want capital appreciation on our assets, but can we find losses along the way to realize to help with some of these tax bills for unwinding stocks or offsetting external gains that might happen in the future?
Right. Yeah. I mean, direct indexing is something that has become very popular in the wealth management space.
Yeah.
As a matter of fact, at that meeting in Miami, I don't know if you even noticed, but there were a lot of fund companies like our friends at Vanguard heavily promoting their direct indexing solution. I think what you guys are doing is much different than that, but can you explain sort of what's different about the dimensional separately managed account versus the typical direct index?
Yeah. It's funny. I remember probably like 5 or 10 years ago, direct indexing was a phrase that was starting to be used in our industry. I feel like it was in the media quite a bit. And I think now direct indexing for a lot of people means SMAs, right, whether they know that or not. Like they're often talking about SMAs if they say direct indexing. So yeah, to your point, there are quite a few things that we do differently at dimensional in our SMAs relative to SMAs that are doing direct indexing. First is the investment objective. A direct index, as the name suggests, it's looking to give you a sample of an index, right? So it's looking to give you benchmark-like returns. That's its goal, is to just give you the returns of that market that you're investing in. And they're oftentimes going to give you a sample of it. So we talked about the S&P 500 as an example, has about 500 stocks in the S&P 500. A direct index might say, we're going to give you 200 stocks of the S&P 500, and we're going to look to give you the returns of the S&P 500. We're going to match that index. When you think about dimensional, whether we're talking about ETFs, mutual funds, SMAs, our objective is to provide outperformance, right? We're looking to provide higher returns relative to the asset class, the market that we're invested in. The goal is inherently different in our SMAs. We're not looking to give you benchmark-like returns. What we're looking to do is give you broad diversification in an SMA. So for example, if we were talking still in this example of S&P 500, we'd be looking to give you the full S&P 500, not a portion of it. And in dimensional, what we're doing in some of our SMA strategy, or all of our SMA strategies, we're incorporating our approach to investing with exclusions, with factor tilts, and with a daily implementation process that helps us create that outperformance relative to the market in a really transparent and consistent way.
Gotcha.
So that piece is really important. And I find a lot of folks jump straight to the tax management when we talk about the differences, because we're talking about tax here. But again, I always think it's important to still think through the investment. Your after-tax return is largely driven by your pre-tax return, that investment experience that you get. When it comes to the tax management side, there's also quite a few things we do differently at dimensional relative to direct indexing. We're looking, number one, to have a daily approach. A lot of direct indexing might have more like a weekly, a monthly approach to things like tax loss harvesting and rebalancing. So if we can look at our accounts every single day and look at opportunities to sell securities and realize losses, and also rebalance our portfolios to keep them on track to the characteristics that we've designed in the strategies, that can help us provide an elevated after-tax return. And then the other piece we're doing differently in tax management is we're not just thinking about tax loss harvesting. We're going beyond tax loss harvesting, and we're thinking about a lot of little levers that also impact tax returns, such as income, which we talked about earlier, full circle, right? We're thinking about making sure we get qualified dividend income and avoiding non-qualified dividend income. We're thinking about things like gifting, corporate actions in our SMAs. I like to think of it as we're looking to manage a lot of details, and we're looking to fight for every basis point in that holistic after-tax return. That's both on the investment side and on that tax management side.
Right. Very helpful. I talk about, not wanting to own sort of a normal index fund that's just market cap weighted, where you're buying the stocks that some committee gets together and says should be in the S&P 500. But the other challenge I have back in the old days using other firms that had tax-managed index SMAs was the issue, which is behavioral, because clients will have a lot of stocks. So they'll have an individual brokerage account. These are individual brokerage accounts with thousands of stocks, maybe 1,500 stocks in them. So how do you get over sort of the challenge with having a brokerage account that has all these holdings? Like I've got tons of holdings, and I think you guys do this for as little as $250,000 or $500,000. So you could own really small positions and a lot of stocks, and you're going to get a 1099 in January from your custodian that's going to be like 200 pages long or longer. So how do you deal with the behavioral challenges of educating the end investor on why this is worth it and the complexity is worth it? Any thoughts on that?
I think it goes back to the use cases and the spectrum that we talked about at the beginning with the tax management toolkit, right? Like ETFs and mutual funds are broadly applicable solutions.
Right.
And you had mentioned, as we go to the right on this slide that we have at Dimensional, SMAs are a little bit more to the right. They're not necessarily for everybody. There's use cases like we talked about. I'm selling a business. I'm trying to unwind a concentrated stock. I want to personalize. So to me, yes, I think what you're talking about is a trade-off. Like to see 1,500 stocks on a statement and to send that 1099 to a CPA who probably has a digital process, but it's still, a lengthier document. How can I be okay with maybe that slight operational trade-off? Well, if you fall into one of these use cases where the SMA is providing value for you relative to what an ETF or a mutual fund could do, you're probably willing to make that trade-off. So I actually think it's more about education on the use cases of SMAs and how it could help an investor. And I think that usually gets people over the hump of thinking through this idea of owning 1,500 stocks. Right. I think the other side of the coin, too, is some people actually might like seeing all those securities on there because you can see everything that's going on in a day. Yeah. But, I totally understand what you're saying, which some of those statements can be really long, and we want to make sure that it's worth it to use that type of a solution. Yeah,
I think for the audience, what I'm really just trying to communicate is you just have to understand what you're getting and why you're getting it and just be prepared. Yep. I mean, you have to be prepared. And, you may determine not right for me, and that's certainly fine. But if you do determine it's right for you, then again, you have to have a conversation as well with your CPA. And you're right. Yeah. They all upload the data right into the tax software. Everything comes up in a CSV file right into the, so it's not like they have to go manually input anything. So actually doing the work is not, it doesn't add anything. It's just, again, if you still want to sort of manage expectations on what, what's coming. So talk to me a little bit about a separately managed account. If we're doing active tax management over a number of years, down the road, we're going to have a portfolio with a lot of highly appreciated securities that are going to be difficult to trade. So what do we do about that? Or is that just the nature of the beast that we just have to be comfortable with, that we're going to, again, at some point in the future, it's going to be very difficult to trade it without creating a capital gain?
Yeah, maybe worth first speaking to why would that happen? Like what's creating that outcome? And then secondary, what do we do to manage that situation? So what you're talking about is, let's say we have an example where somebody invests $500,000 into an SMA. Let's say they start with all cash, right? So they put $500,000 of cash into an SMA instead of using an ETF or a mutual fund. And if they're not adding cash on a regular basis or adding other securities into that SMA. So what we started with on day one is what we're working with into the future. What can happen is, number one, again, you're hoping to have growth on your original investment. So you're going to inherently have gains that become embedded in this investment because you want to make money on, your money. And then number two, as we do this tax loss harvesting, What's happening is we're essentially lowering that cost basis of the allocation over time. And we end up in a position where your account could be called what we call locked, where there's not much more we can do with tax loss harvesting. And then we've got so many gains in the portfolio that to rebalance that portfolio would require us in the future to maybe have to realize some gains. And again, specifically, I'm talking about if you're not adding cash. If you're adding cash to your SMA, this isn't really a challenge that you face because we're buying fresh securities on a regular basis, right? So there's a few things that we consider at Dimensional for what I'll call longevity of your account. Number one, having more securities in your SMA helps extend this longevity out. We had talked about the example of direct indexing takes a sampled approach, and they take a portion of an asset class, versus at Dimensional, we seek to give you a lot more diversification, so a lot more names in an SMA. If we have a lot more names to work with, the impact of tax loss harvesting is going to be spread out over a longer period of time. We're going to give the account more longevity before it becomes locked up. And then secondarily, the other thing that we want to consider is when I get to a place where my account becomes locked up, how do I evaluate the investment experience, the investment exposure that I have? If I'm in an SMA that becomes locked up, but the allocation of that SMA is nearly identical to the allocation of an ETF I would have invested in anyways 10 years ago, but I just got 10 years of tax management value out of it, and now we might not get that tax management value out of it, but I know that the investment exposure is aligned with my philosophy, that might be okay. We might be okay then sticking with that solution versus if I'm in a sampled approach that's simply just looking to give me an index-like return, so maybe different than my investment philosophy, and I get all this tax management value out of it for a few years, when it becomes locked up, I might really feel like I have to sell it. Because it's not consistent with how I would actually be investing. And so then maybe that decision is maybe more forced upon me to sell.
I think that's a really important point. If your investment philosophy hasn't changed, maybe you don't care. Because if let's say you're in retirement and your investment philosophy hasn't changed, you're just dollar cost averaging out of it, and you're still paying capital gains rates, which is certainly, and you still do have some basis. It's very low, but you're still at capital gains rates. So you're still better off than not having created the benefit, long as your philosophy hasn't changed. So so if the underlying investments are still consistent with your philosophy, and you've got 10 years worth of tax benefits out of it, maybe you don't even care. Maybe this is a problem, a solution looking for a problem kind of thing.
Yeah. It's trade-offs, right? And I said that word a few times already, but it's trade-offs. And again, if we're keeping the investment experience at the core here, because that investment experience drives that after-tax return, we felt really strongly that when we built our SMA strategies years ago, they needed to reflect the equivalent ETF and mutual funds pretty closely. Because if you've got this consistency in your investment philosophy, it maybe puts you in a better position when the account becomes locked up. The other thing I just wanted to say on this topic, just to put some numbers to it for anybody who's more numbers oriented, I talked about this idea of tax alpha longevity. What Dimensional finds in our research is if you're not adding cash to the account, you've probably got outwards to about 10 years before the account becomes maybe more like locked up, where your tax value is really diminishing off of that account. When you think about something more like direct indexing, it depends on the firm, it depends on their research, it depends on their live results. But what we find on average is you might get like 3 to 5 years of tax value out of that account. So again, back to this idea, can we extend out the longevity with our approach, with how we create our strategies and the way we manage them? And then number two, can we put you in a position as a fiduciary where you might decide to stay in that SMA long-term, even if it becomes locked up, because you feel confident about the investment experience you get?
Agreed. Very good. So an SMA can be helpful if I've got a concentrated position and I want to use losses to start pulling down the allocation to this concentrated position to have a more diversified portfolio to manage risk, primarily is the rationale for reducing the exposure. Talk to me a little bit about what an exchange fund is and how it's different than an SMA. So that's the next thing on the toolkit that
Yeah,
people,
I was gonna
people
say
may
that.
use, but let's talk about the exchange fund.
Yeah, I would say exchange fund even more specific of a solution than an SMA. So farther right on this
Yeah, fewer people
spectrum.
should use them, probably.
Yeah, and I wish I could draw. When we talked about the use cases of the SMAs, one of the things we talked about was using an SMA to unwind a concentrated stock position with tax loss harvesting. An exchange fund, that's the primary use case. If you're in a situation, many investors are today, because we've had a bull market for 10 to 15 years, where you have one stock that you purchased at a really low price years ago. So you've got what's called a low cost basis, and its market value today is trading a lot higher. And this stock is a considerable amount of your overall investment exposure. Well, you have a lot of risk. Single stock risk, right, is a lot of risk to take on, because if that company has a problem and you've got a lot of your wealth tied into that company, right, it could have a profound impact on your holistic investment experience. So an exchange fund was built to say, if you're in one of these extreme situations, you could put a single security, you could exchange it into this pooled investment vehicle that's a partnership, and you get immediate diversification without paying taxes. So what you're really doing is you're disconnecting yourself from the returns of that single stock, because you're putting that stock in this pooled investment vehicle. You are now instead tied to the returns of the diversified investment vehicle rather than that single security. Right. It's a tax deferral, and it's a diversification tool to hedge that concentration risk that some some clients face.
But you get it day one. You get those benefits day one, unlike
Yep.
Tax loss harvesting in an SMA that may take time. Here you get the risk reduction and the diversification benefit immediately.
Exactly. Yeah, you get immediate diversification. And then I also think there's this interesting piece about an exchange fund behaviorally, right? Like if we've got a concentrated stock position, what does that mean? It means we inherited it, probably. It means that we worked at that company and, our life was maybe invested in this company, and we're really proud of the fact that this stock has done well because we contributed to that company. My point is, usually there's some sort of personal and emotional connection to a single security. Right. And what happens sometimes with SMAs with clients, and maybe some people listening would think about this, is they say, I don't want you to unwind my stock because I love it and I understand the risk, but I may be willing to bear that risk because I love this company and it's done really well for me and my family. What's really cool about an exchange fund is it's giving you the ability to disconnect yourself from the returns of that single stock. But if you want to exit this exchange fund in the first 7 years, you get your stock back. So you have this invisible string to this beloved company that's probably created a lot of positive value for you and your family, but we're reducing the risk associated with being invested so heavily in that one company. So different kind of behavioral components of the two vehicles. Right.
Okay. Fair enough. And of course, these are partnership structures, I guess, generally. And so you just, a little more complexity because of the paperwork and the K-1s coming, and all that. But again, the benefit, if you've got, here in Atlanta, if you work for Home Depot and 99% of your net worth is in Home Depot stock, it's a way to get instant diversification. Again, with, most people wouldn't do all of their stock in this or all of their net worth in it, certainly. But it is a part of the toolkit that I think we don't want to ignore as we're building this out.
Yeah, it's for certain folks. It's a little more complicated. There's more that I would say goes into it operationally up front. There's specific regulatory requirements to be eligible for exchange fund that don't exist for an SMA. But yeah, to your point, it's a really great tool to consider if you've got a lot of your wealth tied up in one security. Right. You could also consider an SMA for that situation. Exchange fund, I would say, is if you're in a really extreme, heavily overweight position.
And you need the diversification immediatay. Yeah, makes sense. Yeah. Okay, so the last two are even maybe smaller appeal or smaller candidates for usage. And they remind me a little bit of a quote I heard from Charlie Munger years ago. Charlie Munger, as you guys probably know, was Warren Buffett's partner at Berkshire Hathaway for years. And he had a line years ago during the financial crisis. He says, there hadn't been a useful financial innovation since the ATM, was Munger's quote. And these last two are innovation about even additional tax strategies. The first one, again, I'm really new to, but it seems interesting, and that's a 351 fund. So can you talk to us generically about what a 351 ETF is and how it's different than the SMA and the exchange fund, as an example?
Yeah. Have you read Charlie Munger's book, Jeff?
Poor Charlie's
As a
Almanac?
side note?
Is that the one?
Yeah.
Poor Charlie's Almanac? Yeah.
Yeah.
Yeah, I've got to come in. Yeah.
It's a very dense book.
Yeah.
I own it. I have not read it front to back.
Yeah. It's great.
Yeah. So 351s specifically are, I would say, another tax deferral and diversification tool, sort of similar to how we talked about an exchange fund, but there's some differences to consider. So let me first explain what they are. What a 351 exchange allows you to do, a 351 exchange is not a product. It's not a vehicle like we're talking about exchange funds or SMAs or ETFs or mutual funds. It's a transfer mechanism. And what it allows you to do is take a basket of positions, typically stocks or ETFs, that maybe have a lower basis so that you're in this position where you don't want to sell them because you don't want to pay taxes on them. But they maybe don't align with how you want to be investing, right? Maybe they're ETFs that you bought years ago and your investment philosophy has changed, to your point. Maybe it's a bunch of securities that you've acquired over the last decade of investing. The point is, it's not one; it's a group. And a 351 allows you to transfer that group of securities into a newly launched ETF.
Okay, so these are new issues when you contribute it.
Correct. It's a newly launched ETF. So the ETF is the vehicle. And the 351 allows you to transfer your current investments in kind, so tax-free, into this ETF. So overnight, you maybe go from, let's say, owning 10 securities to now owning shares of this ETF, right? But we're full circle on our spectrum because now we're talking about ETFs again. And what that's the purpose of that for investors is it allows you to clean up an allocation while still deferring the taxes. And it also, again, gives you a path to diversification in an ETF that is probably quite diversified without having to actually realize the gains and pay the taxes. Then the conversation shifts to what we talked about with ETFs at the beginning, is that now you're a part of this ETF that's a tax-efficient vehicle itself that is broadly diversified. You get to that exposure without having to sell and then buy in cash.
So of the ones we've talked about so far, especially the SMA and the 351 and even the exchange fund, are any of these being scrutinized by Congress or the service? I mean, there's always, when you do strategies to save taxes, you always have to worry about, are the rules going to change on us at some point? Any of these cause you guys any concern on that front?
So I think it's a really fair point. I think there's always regulatory risk, right? Especially when we're talking about taxes. And if you think back years ago, right, like ETFs have become a lot more popular in the last decade, but there used to be scrutiny about ETFs. Right. That the way that ETFs are managed and those mechanics we talked about at the beginning maybe wouldn't be allowed long term. And here we are. I do think when you get in some of these more specialized solutions, what we're seeing happen in our industry is these types of solutions have been here for a long time, but now they're maybe being used with lower minimums and much more broadly across a lot of investors. Right. And I think that's where there's maybe some speculation in our industry of like, how long will these things be allowed, or what's the true regulatory risk that exists with these solutions? Yeah. I know you asked specifically about Dimensional. I mean, for us, those are things we're always considering, right? Yeah. If we're going to launch any investment solution, we want to make sure that it's an investment solution that's going to be around long term for our clients, and we want to make sure that we've left no stone unturned and all of the the different pieces that we have to consider to ensure that we can have a successful solution. Regulatory risk is always one of those.
Well, I mean, I guess the devil's advocate, even on the SMA, would be, well, heck, maybe I should take capital gains at 15% long-term capital gains rates because I should take them today and not defer them. So maybe deferrals. So, it's all about diversification and not putting all your eggs in one tax basket as well as asset class for sure. Okay, the last one is probably the most complex, so we don't have to spend a lot of time on it, just high level. But there are asset management companies now that are offering SMAs that they're also adding short positions too. So they're taking an SMA and they're adding a long position, so they're owning the stock long, and they're also taking stocks that they don't like, using whatever factor models they use, and they're shorting them with the idea is there's always something to harvest. I don't know what the generic term for these are, maybe long short SMAs or, 130, 30. I mean, probably see different names for them. So are you familiar with those? And if you are, can you tell me sort of your take on them and what you think the potential opportunities or risk may be with them?
Yeah, certainly familiar. I would agree. Most would refer to these as long-short SMAs versus what we had talked about earlier with dimensional SMAs being what I would call long-only SMAs, if we want to get a little more technical with it. So maybe let me back up. When you think about the dimensional SMAs, and we talked about a few minutes ago, a couple of the things I said was that how do we look at dimensional to kind of go above and beyond tax loss harvesting and elevate client outcomes? It's through having a daily approach. It's through having broader diversification. And it's through the portfolio construction, and the implementation of the actual investment experience in the vehicle. Long shorts, SMAs, it's a different approach to thinking about trying to elevate on tax management, is how I would describe it. And what they're looking to do to create more losses for a client, so to elevate on that tax management relative to direct indexing, is take on leverage. So that might be, that could be a reasonable approach to create more losses for a client and reduce a tax bill. But when you think about leverage inherently, there's a lot of risk associated with that type of an investment approach. There's higher costs associated with that type of an investment approach. And there's a lot more complexity to consider when you think about what I'll call unwinding the leverage. So selling down that leverage and liquidating that leverage over time to reduce that risk associated with the leverage itself. So it's definitely a really complicated solution. We see some investors deciding to use that, again, because they want to try to increase the amount of losses that they can create out of an SMA. Oftentimes when I'm having these conversations with advisors like you, Jeff, right, we're talking about, do we need to take on all of those costs and all of those risks? And are we doing due diligence on the investment approach of that long-short SMA provider? Right. If you feel that it's worth it based on those criteria, of course, that's why clients work with you. Do you feel like diversification, a daily approach, lower costs, a consistent investment philosophy can get you to the outcome you're looking for from a tax perspective? Yeah,
without the cost and the complexity, perhaps. Yeah. Okay, yeah. Fair enough. Very good. Well, Kacie, this has been awesome. I've taken, the whole hour here. I thought this was going to be a great show with a lot of content, really helpful. And, this show is really designed to marry together conversations around, what provides meaning and purpose and how do we live a great life and how do we go be what we were called to be. And then how do we create the capacity through good planning, through good investments, good tax planning, estate planning, and have some deeper conversations about how we can help our audience, keep more of what they earn, which can obviously give them the opportunity to create the capacity to go do what they're called to do. And I think you serve that purpose today in terms of helping us think through the toolkit and the options that are out there. So if people want to check out your content or learn more about Dimensional and what you guys are doing, what's the best way for them to follow you or follow Dimensional's information and all the things you guys are putting out?
Yeah, a few different avenues that they can look to learn more about Dimensional. Our public website at Dimensional has a lot of content. Our LinkedIn, our YouTube, I would say, has a lot of content. And probably most importantly, I would say through you, Jeff, working with you and your team. As you know, we we love to engage with your clients through webcasts and events, and the different things that you guys put on at your office. So also through their engagements with your team.
Great. Well, thank you so much, Kacie. This has been fantastic. I really appreciate your wisdom and your teaching, and you are a great communicator on this. So I can see why they gave this assignment to you after being on the committee to spearhead it, because you are a great communicator on some of these pretty complex subjects in some areas. So thank you all for checking in with us today. I hope you enjoyed the show. Hope you found some value in it. If you'd like to check out past episodes, the Money and Meaning Show is on all the streaming platforms. Please check it out. Give us a rating. Share it with a friend. If you want to learn more about me and the work that we do, you can find us at tandemgrowth.com. You can check out my book, The Money and Meaning Journey, A Guide to Clarity, Financial Confidence, and Joy, at all major online retailers as well. But again, thanks for joining us today. I hope you make it a great day. Take care.
Thank you for listening to the Money and Meaning Show with Jeff Bernier, a show dedicated to help you gain the confidence and freedom to lead a life of personal significance and help you get your actions and resources in alignment with what matters most. We would love to hear from you. If you have any questions or comments on the show, feel free to reach out to us at moneyandmeaning@tandemgrowth.com, or you can find us on the web at www.tandemgrowth.com. Jeff Bernier is the President and Chief Investment Officer at Tandem Growth Financial Advisors, LLC, an SEC-registered investment advisor. This show is a production of Tandem Growth Financial Advisors, LLC. All information discussed is general in nature, is provided for informational purposes only, and should not be construed as specific financial, legal, or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Listeners should not rely on the content of this podcast as the basis for any investment decisions. A professional advisor should be consulted, and/or independent due diligence should be conducted before implementing anything discussed in this show. While information presented is believed to be factual and up-to-date, Tandem Growth Financial Advisors, LLC, does not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Tandem Growth Financial Advisors, LLC, does not make any representations or warranties as to the accuracy, timeliness, suitability, completeness, or relevance of any information prepared by any unaffiliated third party, such as guests on the podcast, and takes no responsibility for the same.